if you move $250,000 over to them and you get your home mortgage through them, they'll give you a 0.25% discounted rate. Okay, so they're giving you a 0.25% discounted rate. The best thing is they're taking that loan, they're selling that loan off, so not even really lending you the money, and then they're taking your $250,000, making 100% on it, and graciously paying you 0.16%. So when you break it down like that, it's like, wait, I'm giving you $250,000. Okay, you're saving me a quarter on my mortgage. Yeah, but they're taking that $250,000 and making $25 million.
Welcome, everyone, to the, what did we say? I already forgot. The 15th, 16th, the 17th episode of the Casandra Properties. No, we don't cut here. We just roll. The 17th episode of the Casandra Properties podcast. We are joined today by Jeff Van Note, the mortgage quarterback. This is one of those podcasts, folks, where if you're looking for value, you're going to get it. We have a lot to cover. We have Becca joining us today as well. How we doing, Bex?
Hi. I'm good.
Good to see you.
Oh, yes.
Not really. So, as we always do, Beck, you want to kind of jump in and let's find out what's made Jeff the entrepreneur that he is today.
Yeah, I was just gonna say that. So, tell us a little bit about your childhood. How did you get into the mortgage business?
So my childhood was really revolving around sports. I lived for football, baseball, basketball. I tried soccer. I hated it. It was too boring. I remember one time playing goalie. Like, man, the action's going on down the field. I can't come out so far, so I stopped playing that. I played roller hockey. I played goalie. So like this is kind of boring again. So I always found myself like trying to stop people trying to score, and then like me going out there trying to score in all the other sports. From there, I wanted to play in the NFL, so I cut basketball out and then I cut baseball out. And
what position you play?
I played quarterback. It was actually funny. So I played goalie because I was like a chubby kid growing up, but then I hit my growth spurt. So I actually went from playing like center to quarterback from the 6th grade to the 7th grade, which is unheard of, You usually don't go from line to quarterback.
Yep.
And then I evolved into wide receiver because I had to get in the field. But you asked, what made you or what makes you like an entrepreneur? How do you get into business? And it's like anything else. Like anybody that wants to find a way, I believe will always find a way. So I had an opportunity to play quarterback. I was grateful for that. I learned the whole game. I had to know where everyone was. I had to know what the defense was doing. So that allowed me to see like an overall vision of the field, right? Like if I thought somebody was going to blitz, I needed to prepare for that to be able to like run away from them so they didn't tackle me, right?
Right.
And then when I went to high school, we had 3 quarterbacks that were ahead of me. We had a freshman with me and a junior and a senior. And I'm like, man, well, okay, so next year the junior is definitely going to play and start. I'm going to be competing with the kid that's my age. I don't want to wait until maybe my senior year to get in the field. And I definitely don't want to not ever get an opportunity. So where are the holes where I could potentially get in the field? And it was like running back and wide receiver. I had never played running back or receiver ever before in my life. But I'm like, if I could do these and consistently produce here, I got a good chance of getting on the field. And I actually thought I was going to be running back. I was on the scout team for running back playing against varsity. And then all of a sudden it was like, wow, you can catch the ball. Oh, our receiver got hurt. Hey, go in receiver. And then next thing you know, my junior year, I'm starting at wide receiver on varsity with a pretty good team. So I kind of looked at my opportunities ahead of me. I knew I'm not a patient person, if you guys didn't catch that yet. Most people aren't, right? Especially in real estate. So I was kind of like, well, whatever I can do to get in the field as quickly as possible where I can contribute to the team, put myself in the best position to win, I have to do that. I have to teach myself, hey, suck it up. Like, I do want to play quarterback still to this day. I wish I played quarterback, but I still would be sitting here not telling, my sports journey. Still
you have athletics in the family.
Yeah, so my uncle played for the Atlanta Falcons, which is pretty cool.
That's really cool.
He played for one team for 19 years, 1967, 1986. His jersey's hanging in the rafters.
That's so neat.
So
That's
for me,
awesome.
that was kind of like same name,
cool.
really awesome.
Absolutely.
Yeah. Yep.
So
Cool.
did you? I'm a big football fan.
Sure.
Did you get to meet any of the players? I mean, what?
So it was interesting. So I would always go to like Giants and Jets games because they were close to being home, and I was never a fan. Like, still to this day, I'm not a fan of a team. Kind of like I get inspired by players. I like players that have certain attributes.
Yeah.
I respect the hard work. I respect the God-given talent. If I had to pick a team, I'd probably pick the Green Bay Packers only because the community of Wisconsin owns the Green Bay Packers.
Yep.
I don't know if you know that. Whereas all the other teams are privately held by like people for
the
40
Tisch
plus
family.
years. Yeah, big names aren't changing hands. So I feel like it's an invested interest, and like I'm a big like community guy. Like I like the teamwork, camaraderie. But if you have a owner at the top that's making $1 billion a year, and then the running back blows his knee out, you never see him again, he's forgotten about. To me, that's not kind of real teamwork. Like, you kind of want to help people along the way. So I feel like sports in general, back 20, 30 years ago, people didn't change teams that much because there wasn't as much money in the game. Now today, it's all about money. So I treat it for what it is. It's a money game, not really what it was as a passion project.
Yeah, certainly. There's been quite an evolution in sports and how that. I'm a big football fan. I've always been a big football fan, but it's become more difficult to hang in there.
Very tough.
Honestly,
very tough. I was a Deion Sanders fan, so you went from Falcons, then I believe to the Niners, right? Then to the Cowboys, and I think he retired on the Ravens, right? So even look at like a Johnny Damon played for the Red Sox. Okay,
comes to the Yankees.
Yeah, right. Yeah. Wait, you just went to your rival. That's one thing you don't do is go to your rival. But today, Brett Favre went from the Packers to the Vikings. And it's like that's to me like that's not how I was raised. Like you never join the enemy. Unless you have to.
So
Too funny.
Because I know you've got a strong tie to the community and you're very civic minded, as are we, and I think that's important. So why don't we talk a little bit about the 2008 crisis and what you saw, and I would assume that those were some of the motivators and influenced you in different ways, right?
Yeah, it was really an interesting time. I get the chills whenever I think about 2008, and it's one of those things that unless you lived through it when you were in the heat of it, you kind of just are an outsider looking in. You got your popcorn, you watched your movie, you watch The Big Short, and you think everything, right? I'm gonna give you a different perspective of from the inside of my car. The day Lehman Brothers finally closed its doors, right? I was a senior in college, so it was 2008, so I was 20. I was about to be 20. 21. I was 21. Yes, I was about to be 22. I'm sitting with my best friend who now works at Goldman Sachs. At the time, he was probably going to go to the NFL. We thought we were going to go to the NFL. I was an All-American at Fordham, broke a ton of records, really, really talented, naturally gifted kid. And every Thursday night, we used to drive into Manhattan from Fordham in the Bronx and get halal food. If you know halal, it was the place to go. Everyone did it. There were lines so deep. And I'm I think we had the Garmin navigation at the time because phones just started sending picture messages back in 08. I think.
That's so true. Yeah.
That was only 12 years ago. So we drive down and we park on the right side of the road in Manhattan, and so you have the double line, and then you have obviously the other side oncoming traffic, and we're sitting there and we were watching grown men carry their lives out of Lehman Brothers boxes, right? And now this is months after Bear Stearns had gone under, or was in the process of going under. It was in that during that time frame, and I was doing mortgages at the time, but again, I didn't know what was going on. But that was probably the most real surreal moment in my life, where again I'm a 21, 22-year-old kid sitting in my car watching people that were making hundreds of thousands of dollars a year. One of the biggest corporations on Wall Street dissolved in the blink of an eye, and all I can remember thinking was, I don't ever want to be that guy. I don't want anybody to ever have control over my destiny or fate. If I'm going to go under, if I'm going to be on the Titanic, I'm going to be on the Titanic alone, but the captain's not going to tell me my ship's going down. You know what I mean?
Yeah.
So I think, for me, I took that as I need to figure out what's going on. I need to figure out what caused this, and I need to figure out really how to help prevent this from ever happening again, right? So for whatever reason, I was born an empath, right? So I feel bad for people. And I really, to this day, it's very tough to point fingers, right? I feel like when something goes wrong, everyone has to hold equal responsibility. So people blame the banks. I understand that.
Yep.
People blame the consumer. I understand that. People blame the realtors, the mortgage. People blame everyone involved.
Of course.
But at the end of the day, everyone needs to take responsibility for it. And again, knowing what we're in today, I don't necessarily think the banks are wrong, and I don't necessarily think the consumers are wrong. I think it just stems from a real, true lack of education and also a ton of greed.
That started at the government level.
Definitely. And like anything else, they were ruled by the almighty dollar. But from a political standpoint, this is all based on what my research has shown over the past, call it 13 years now. The government was pressured. They were pressured into allowing everybody the opportunity for homeownership, right?
Right.
So when they come out and say, hey, 45% of Americans will never own a home. What can we do to get these people to own a home? Well, the first thing should be like, hey, let's educate them and help them get a job.
Right.
Not, hey, let's give them a loan on a real estate where they don't have a job, they don't have income, they don't have assets, they don't have the financial wherewithal or education to succeed in this home. And even if they can make the mortgage payment, can't pay the taxes, can't pay the insurance, can't furnish the house, can't fix the boiler when the boiler goes or when the roof leaks, right? So again, people forget that the government was pressured into creating these loan products. And then what did they do? Hey, Wall Street, will you guys buy this crap from us? So now Wall Street's like licking their chops, right? Oh man, like we can make a ton of money for doing nothing. Let's just create this, BS loan product so everyone has it. Let's make a killing. We know it's not going to work, but let's get the headline that we're trying to help all the dreamers get their home.
Yep. Right. And they got ratings, and then they became bogus ratings, right? To continue
they lied about everything.
To fuel the machine. And a lot of people made a lot of money through that run, and it was absolutely. We had testified as a company at hearings. It was our local state senator, Diane Savino, who was really passionate about this, and she had asked if we would come down and testify at a state senate hearing and kind of give the scoop of what was really going on. So we didn't do any subprime mortgages. We wouldn't be a part of it because of what you had said. When you have people that were buying real estate and they were literally walking out with money.
Yep.
So they were putting $5,000 down on $400,000 and $500,000 deals.
Yep.
They were getting 106 and 107% financing.
Yep. They were walking out with $50,000 in their pocket.
They were walking out with money in their pocket, and nobody stopped to explain just what you said. If the water heater went, or as your tax abatement burned off, or as fees, taxes here, they do nothing but go up, right? And as these little incremental things started to happen, it just became part of, we'll leave the keys on the counter and walk. So we had testified. I gave this, I'll never forget. It was one of those, you have those moments where you're like, oh man, like it sticks with you.
Too many of those in my life so far. By 33, I'm starting to get on my second hand counting. But yes, I know that feeling. Yeah.
We went and spoke, and it was my then partner, John Patera, in the business, and we did all sorts of preparation, and we went in and we talked and we talked and we talked and we talked, and you could see the glaze come over the eyes of the panel, and it wasn't that they didn't want to listen. It was they genuinely did not understand what happened and how we got where we were. And at that point, the cat was out of the bag, and it was too late. And we had gone and we traveled around primarily the Northeast and looked at different projects and different opportunities, as these bundles started to become available.
Left and right.
You were buying houses in Detroit for $800, literally. Right. And that was you were the second person in the chain. The first person in the chain was buying them for $250. Yep. And, you found entire communities that were built where literally the keys were on the counter, the boat was in the driveway, like it was almost like you're in a zombie movie. Walking through these communities going,
it's crazy.
Like an old Western.
What happened here? New York being the epicenter of jobs, we endured in a way because there was always the opportunity for employment. Yep. In some of these other towns and outskirts of the cities where they didn't have that employment base, it was wild to walk through. People literally picked up and just moved to a different state. They packed what they could take with them, right? They got in the car, and they moved on, and that was it.
I had a deal recently. So I haven't originated a residential mortgage loan since like May of 2017, and for many reasons. And I've lived a much more peaceful life since, from doing the type of volume I was doing. So it's been nice to take like a breath of fresh air and like really take a step back to look. That's all I knew for a decade, right? A decade which I was supposed to have tremendous personal growth. I didn't have that because I was always focused on business, right?
Yep.
I had a deal recently where past client I closed in 2013 referred me the family friend, and I'm like, look, I don't do this, but I'm gonna help navigate you. I'll put you at a bank I know. You're trusted. Like crazy times. We'll make sure everything goes smoothly. We review the credit, 680. No delinquent accounts. No derogatories. No bankruptcies. no nothing, 50,000 in the bank. So like a very qualified buyer in today's market, right? In my opinion, ratios in line. The loan goes to underwriting, and fraud guard pops up. Like CoreLogic, they run a fraud guard to make sure like name aliases, like prior property zone, making sure like you really are who you say you are. And it says foreclosure 2018. So I'm like, got to be the wrong name. Like I know your last name's Sanchez, and there's probably like 10 million Sanchez's that are trying to buy home. In America right now, like there's a ton of Sanchez's. It's got to be the wrong person. So I email the client, hey, the bank just called me up. Do you know anything about this? Nope. I'm like, are you sure you don't know anything about this? Now, it was a quick nope, like, hey, no, that's not me. Usually when someone's not guilty, they're like, no, that's not me. What are you talking about? Like, I have perfect credit. So I dug deeper. Turns out her and I believe her brother in 2006 took out like one of those option one mortgages, option R mortgages where like the balance keeps going up. 2006, they wound up getting mold in the house in like 2011. So they said, hey, we don't have the money to fix the house. What do you want to do? They listed the house for sale. They were told the short sale went through.
Oh, no.
In 2013. So they're like, all right, we're done. That's fine. Like, the bank did what they had to do. But it got caught in one of those areas where the banks saw an appreciating value. So the bank actually killed the short sale, never told them. And the house didn't get foreclosed on until July of 2018. And you need 3 years for to get an FHA mortgage. So they were like 10 months away. And obviously the loan got denied.
Right.
Not on the credit report because the loan company that did the loan was out of business. The worst part is Capital One was actually the loan company that purchased the defaulted mortgage and sat on it for that 6-year period. Wow. So you have a client that literally forgotten about it.
Yeah.
You're talking about 7 years later, they didn't foreclose for that time period. Wow. So like, again, like people say like, oh, it's all gone, forgotten about. Think about it, they got the loan in 2006. This is 14 years later, and you're still hearing like ghost stories
That's crazy.
So I'm like, every time I say I've seen it all, like there's always that one extra time.
Else, yeah. Wow.
So like again, wild. Think about it. Like the aftermath from 2006 is still haunting us today in 2020.
Now you've had a lot of success though. Before you got into the commercial game, you had a lot of success in the residential game. You did quite a bit of volume, right?
I would. So I think success is indicative of the person. So like I think that I was very successful given the age, given the time frame. I could have done a lot more if I didn't do everything else on the side, if that makes sense.
Sure,
right?
It does.
And also, what's important to know about that is, of those numbers, I walked away from different demographics. So I built a $30 to $40 million a year Bronx business, and then I left and I targeted Brooklyn. And then I left and targeted Harlem, changed my phone number, and then moved to Jersey, right? So I always tried building different businesses to learn the flow of the market. So I would consider it success, but I think, again, given the times and like given how young I was, I think I could have been so much more successful had I had better management or leadership, believe it or not.
Well, I have right here that you were voted 3 times 40 under 40 most influential mortgage professionals in America, all while under 30 years of age.
Yeah.
That's a big accomplishment. That's huge.
Yeah, so it was cool. It was really nice. And again, like I hope this comes off the right way. I felt like when I had come into the game, the rest of the industry was kind of like defeated. A lot of like the real players that were doing business, got knocked out or they left because it was hard, So I always said like, as good as people like perceived me to be, it was almost like perfect timing for me because I'm coming into the game as a 21, 22-year-old, don't have any bad habits or experiences in the business, doing business the right way, hungry. Like if I make $5,000 this month, I'm having a record month. Meanwhile, these guys need to make $20,000 a month just to survive, right? So I was coming in all off of like morale, off of like the football field high.
Yep.
And these guys were like, man, we're trying to survive. Business is terrible. There's no more loans. You know what I mean? So like, yes, those are all great, but again, as like rewarding as that was, there's still nothing more rewarding than like the actual amount of people I help. Like being in the Bronx, I pushed every legal lending limit possible, like every credit score requirement, So like that's where my real value, like accolades don't show, like the Miss Smith family that got denied that now has, $1 million home because
a success story.
Yeah.
That's to me, like that's the real success, like things that you don't see in headlines. You know what I mean? Like having 1,000 clients closed by 30, of which probably I still talk to on an annual basis, 750 of them. Like, to me, like, that warms my heart. So, like, when people reach out to me from 2008 and 9 still to this day, I'm like, wow. Like,
You're doing something.
Yeah, exactly. That says something.
It's so nice, again, like, going back to that, and, like, I always joke around with them, like, man, if I'm old, how old are you guys? You know what I mean? Because, like, I know you were older when I was, So, like, that, to me, like, that really means a lot. And I wish the rewards in the mortgage business and even in real estate really focused on the impact people had on the community more so than the amount of business you did. You could do 10 deals and really impact 10 people's lives, or you could do 100 deals where it's transactional and it's not worth anything.
Without a doubt.
All about perspective,
At the end of the day, none of us are going to be judged on the volume that we did.
At all.
No.
Right?
At all. And no one cares.
Nobody cares.
That's true.
Nobody
Yeah.
cares.
You have to leave a mark. You don't have to leave a mark, but you should feel compelled to leave a mark in your community. You should feel compelled to leave a mark in your respective industry.
Yep.
And, I was very hard on myself, and I still am when I look back. I'm now 45. And
Young. So you were 30s, in your 30s when it happened.
yeah. So
You're my age, 33.
yeah. So, you look back now and what you were kind of referencing earlier about, I had some success, but I should have been. You have to go through that.
Have to.
You have to live through it. You have to experience it in order to reframe yourself and become more intentional in what you're trying to do. And as you become more intentional in what you're trying to do, you see the dividends explode.
Forever. It's the
And
best
I don't
annuity
mean
you can
financial
create.
dividends.
Yeah.
Right?
Of
It's
course.
all those relationships
Yep.
that you've made. What you're going to find is in the next 10 years, it's almost like it's happened to us, right? Where you're almost like you wake up, and for decades you're fighting to build a business and what the next thing is going to be, and then all of a sudden just pieces start to fit.
Yep.
Right? People as life goes on, they have a way of looking for the folks that stood up, that did the right thing, that didn't make the quick buck, and opportunities will present themselves. And instead of having to go out and find that next emerging market and try and, you always want to be ahead of things. You always want to be vigilant in whatever you do. But the ability to go 2x, 5x, 10x, it happens. These
Instantly.
things start to click, and you can then start to pick the opportunities that you want to pursue that, of course, give you an opportunity to earn a living, but also allow you to leave that mark. Right. So I wish you luck in the next 10 years. I think you're going to have tremendous success.
That. I hope so.
Yeah.
I always say, like, man, I was on a path, like, I felt like I was going to die by 30. And then it was like, I think I'm going to die by 35. Now it's like, I know I'm going to make it to 50.
There you go.
I know I'm going to make it there. So interesting. Appreciate that.
So the market, we had talked a little offline before we started, and we wanted to jump into what I think is really some of the value that you're going to be able to bring to my audience here. Let's talk about what's happening in the market today. What are you seeing out there in the real estate market, in the mortgage market? What's happening behind the scenes? Give the audience a little feel from someone who's really dialed in. What is it that you're seeing on the ground?
It's funny. I never, people be like, I'd be out, and I was like 23 years old, like, what do you do for work? I'm like, I kind of just hang out. And, because my audience obviously didn't need a mortgage at the time. So, like, if I'm hanging out at, like, a club in Manhattan, I'm not going to be, I do mortgages. Like, mortgages? What's that? Like, like, they don't know what mortgage is,
Right.
Back then.
So true.
Right? So, I stopped telling people I did mortgages because I'm like, everyone thought mortgage people were bad people for so long.
Yeah.
For so long,
Yeah.
right? So, I also never liked banks. Like, I knew how they operated,
Right,
So, I'm
yeah.
like, I'll give you an example. Like, I'm like, I have a single mother. She's got 4 kids, and, she needs this. Like, no, charge her a point. I'm like, no, we're not charging her a point. You're going to eat that. So, like, it was always like, again, me advocating for the consumer, like protecting my clients. Like, I can go to any bank I want. My client, they're with me, right? So if they get screwed over, this isn't going to end well. So I tell that story because banks cry when they have no business. Now banks are crying they have too much business.
Yeah.
Right? So now what do? They raise rates. What does that do? Hurts the consumer. Right? They're like, well, we have more business than we know what to do with. We're going to pick and choose. And if you don't want to pay our premium because we're busy, we're not properly staffed, we don't have an efficient system, our client interface is terrible. Our processor only works 5 hours a day. And now that she's home, she's replying to emails once every 2 days. Like, horrible customer service, right? So like COVID really exposed all this. So banks right now, both on the residential and commercial side, are looking for reasons to deny loans.
Yes, they are.
And, you know, and
That we know.
and I feel like no one's talking about that. One, because of headlines, right?
Yep.
Obviously, banks are setting record numbers. Banks originated the most amount of mortgages. Real estate's up 7 trillion% this year. Home prices skyrocket. You know, like all these like crazy headlines, right?
Yep.
But you don't talk about the person that like I spoke to last week that got denied by Wells Fargo, who's refinancing her mortgage, is with Wells Fargo. She's going from 5.5% on a loan from 2009, wants to drop down to 2.75%. And they denied her for not having enough money in the bank when on a one-family home primary residence, you do not need reserves. And she has it in her retirement account. So, like, wait a second here. Like, I'm confused, you know.
Right.
Wait, $150,000 loan. The house is worth whatever, $400,000, 800 credit score. Why did you deny her? Like, when I say, like, there's no better borrower, like, you could tie her up with the best of the borrowers that are out there that exist. And again, like, I've always looked at, so how I really made a killing, to be honest with you, was other banks' fallout, right?
Yeah.
Deals like that. The majority of my deals when I started doing the business from 2007 to 2011, let's call it, because that's really that window of like tremendous opportunity for someone like myself, like perfectly positioned. Everyone else was the bad guy. I was there to help people close. So the majority of my business that I was closing that time frame was deals that got denied by other banks, or like the guidelines were like 1 or 2 points off, and we figured out how to get it done. And we're back to those days now.
Bank declination lists are gold.
Huge. Yeah, huge.
Gold.
And nothing better than the realtor that needs to close a deal for the commission that calls you says, I need to close this deal in 2 weeks. And I'm like, I'll close you in 13 days. You know? And again, we're getting back to that. So people, as much as they want to say, oh, we're customer focused, we want to provide 5-star, we're on social survey, all this crap, right? We don't want to get bad reviews on Google or whatever. They're lying. I mean, I'm being honest with you, like they're flat out lying, you know? And that's where my problem is, because again, at the end of the day, the consumer hurts from that. And now with, you know, the December 1st implementation of the adverse market condition by Fannie and Freddie, you know, your rate's going to be higher, or you're paying a 0.5 point fee. So like my thing is everyone's squeezed in for December 1st. All the banks are going to try and close as many loans as they can, and it's going to be a ghost town for a while.
Yeah. So one of the big misconceptions out in the marketplace is people hear mortgage broker, like you said, and they go, ooh, you know, same thing, real estate broker, ooh. But if you get the right mortgage broker, what so few people understand is you're a bank's worst nightmare.
Yep.
Right?
Worst.
You're the guy that has a pro, and I really respect you for getting up into it and understanding the guidelines as intimately as you do, because when you're able to connect with somebody who has that profound of a knowledge, you absolutely can cut through all of the nonsense. And when someone comes to you, you know, people have the misconception, well, if I go to the bank direct, I'll get the best rate. False. It couldn't be further from the truth.
And they don't want to deal with you because they're getting their salary.
Right.
They don't want to close your deal.
Right. When you go to the right mortgage broker who understands your file, understands your asset, and then can go out and find the absolute best lender that you know doesn't have maybe one of these additional guidelines that are not Fannie or Freddie guidelines, or there's a not traditional guidelines that's a bank-imposed restriction, you can find that thread and you can pull on it, and the next thing you know, you're in the sweet spot with lenders that you never even would have thought of pursuing.
Yeah, your average person calls the person they have their mortgage with, the person they have either, again, ballpark their checking or savings account with, right?
Yep.
Or who their family member that they're closest with got their mortgage with. That's who they call. There's only like usually 3 calls. Or, again, you have Quicken Loans, obviously, in the millennial category, or you go online, like best mortgage rate, Staten Island, who comes up, okay, let's call this guy, right? But with that being said, there may be a bank out there that has the most attractive terms, the fastest turnaround times, whatever, the lowest amount of fees. That's really where the value is, right? So how I've kind of positioned myself is, you know, with the banks right now, knowing their weak spot, every bank's weak spot are deposit accounts right now, right? So my commercial clients, if they have money with X bank, whatever, and they have no mortgage currently commercial with them, I lead with what their deposit's going to be.
The depository relationship.
So I say, hey, look here, you know, my client wants $1 million loan. They have $400,000 in the bank. they said that they'll move, $100,000 over to you before they even apply, just to start that relationship. And now all of a sudden, the level of customer service that they get is 10 times better because they're required to bring in deposits. And with interest rates being so low, the biggest deposit accounts are all withdrawing or putting their money into the stock market. So their deposits on their balance sheets are so limited, so reduced, that they're actually very, non-compliant to the regulatory issues that they're having. So if they don't meet a certain threshold, they can't lend. So if they don't have enough cash, they can't lend. Now all of a sudden they're not making money on lending. They don't have the deposits. Now they're like, what do we do?
Yeah, exactly.
I want to slow it down for a minute and explain to the audience what you just covered in detail, because the overwhelming majority don't understand how that works. So when Jeff is talking about if a bank doesn't have liquidity, then they're out of compliance. That's not the bank's liquidity, right? That's your money.
It's your money.
Right? So your deposits are what the bank uses in establishing that liquidity when they go out and they secure their lines that they're going to lend from. So when you're taking your money and you're putting it into the bank and they're gracious enough to give you a 0.5% or
If you're lucky.
0.25%.
Yeah, I think it's like 0.16
right
now.
It's ridiculous. They're using that money to leverage the loans that they're then going to give you at the spread. And of course, the banks have to make money. I get that. But so few people understand that they have all the power.
Correct.
Right?
Which is why there's a bank on every corner.
Right.
Yeah.
Right. So the deposits and the depository relationship for a bank is paramount, because without those deposits, they can't go to 5x, 8x, 10x, whatever that number is, to secure those lines to lend you that money back against your deposits.
Right. I mean, the best is like a Wells Fargo, for example, where if you move $250,000 over to them and you get your home mortgage through them, they'll give you a 0.25% discounted rate, right? Okay, so they're giving you a 0.25% discounted rate. The best thing is they're taking that loan, they're selling that loan off, so not even really lending you the money, and then they're taking your $250,000, making 100% on it, and graciously paying you 0.16%.
Right.
So when you break it down like that, it's like, wait, I'm giving you $250,000. Okay, you're saving me a quarter on my mortgage. Yeah, but they're taking that $250 and making $25 million or whatever the number is.
Right.
So that leads us to the meat of the day, right? Like the meat and potatoes of what I wanted to get into, which is, as the millennials continue to come into their own, and I think it was, what did we say, 2025, right? By 2025, 75% of positions in these companies will be held by millennials. And they operate under vastly different rules, yet we're not seeing the banks, particularly on the commercial side, like Rocket Mortgage, and there's some neat things that, some fintech that's been deployed that's worked on the residential side. But on the commercial side, we're not seeing the banks catch up.
You're actually seeing the opposite. They're actually slowing down even more.
Right. So what do you see happening in the next couple of years? Where's the opportunity? And then we could talk about some of the things we chatted about.
Yeah, I believe the opportunity, first of all, opportunity will always be with private money. So when you have big commercial real estate players, or, I have different buckets of money I get for clients. So depending on their needs, the time frame, I have everything from my, guys on Wall Street that are big bond traders, to Indian group. They've never lent before. I got them to lend, and they'll lend. Again, I don't want to use the term blindly. I never say that. They trust my underwriting with their 24-hour due diligence to know whether a deal's good or not. It's pretty much just Googling an address and making sure the attorney signs off on it, right?
Right.
It's a legitimate deal. So private capital, I see a massive, massive, massive opportunity over the next 24 to 36 months. I said that also last year, but obviously COVID, extended that. So my 24 to 36 months is now like 36 to 48 months, because again, we don't know the aftermath that this is all going to cause. We haven't even seen it, part in such because of PPP. PPP, in my opinion, just delayed the inevitable for so many people.
Absolutely.
If you relied on PPP to get through the last 90 days, odds are your business is not in financially good health. And it is what it is. Like, I'm not saying that to hurt anybody's feelings, but that's the truth of the matter. And the sooner you realize that, the better off you can position yourself to plan for the next lockdown, if that ever happens in the next 100 years, which I hope not, right? So with that being said, non-QM if you're familiar, non-qualified mortgage. So to give the audience a brief look into that, 2012, Dodd-Frank came out. Dodd-Frank, to my knowledge, basically got 5 people that knew nothing about mortgages, nothing about real estate, and said, how do we improve the mortgage business? And they came out with these rules. It was like, okay, so we don't understand how this works. The banks can't figure out how to read this document. The consumers think they're spending $100,000 more. A plus B doesn't equal C, but this improves the mortgage business, right? And part of what they found was the problem, which was the problem, was what's called the ability to repay. So they basically looked at what's called your debt to income ratio, right? What is your guaranteed income versus what are your minimum monthly payments inclusive of your mortgage? You can't exceed a certain percentage threshold. If you do, you do not qualify for a mortgage. Mm-hmm. Fast forward 5 years later, when everybody forgets about, 2008 collapse, forgets about all the lives ruined and collateral damage done, they implement non-qualified mortgages into the market, which are not RESPA or Dodd-Frank regulated. They got around it by doing what's called a business purpose loan for real estate. So it's an investment property. It's a creative way of saying, we know you don't qualify, but because you're getting it as a business loan, your consumer rights are no longer valid, even though you're still putting it in your personal name. So I see an opportunity for non-QM, which is basically your self-employed borrowers, your borrowers that have a ton of write-offs, your borrowers that don't show a lot of income, your Uber drivers, if you will, that can go out there, still have the ability to purchase a property with larger down payments, 20 to 35%, let's call it, factoring in the rental income from the property. Only problem is now that was a ticking time bomb. It still is a ticking time bomb because, again, basically the people are saying we don't qualify for a mortgage, but hey, we have a 3 to 5 year run, and then that's going to blow up like it did in 2008. So we're coming on year 3. What's interesting about that is in March when COVID happened, they halted all non-QM lending, right? So it always scares me from everything I've seen in the past, but with the ability within a 1 hour window, a loan product can be gone, right? Yeah. And the last time we saw that was 2008, right? So that kind of alarms me where guidelines start changing. Cash reserve requirements, credit score requirements literally can change on a dime. So you could think you have 10 loans in your pipeline and someone says, hey, we want 680 credit scores only. You have 2 that are 660. You just lost 2 loans overnight without even doing anything wrong. So that's why I believe non-QM is a good alternative, but private capital has much less restrictive guidelines, where if you're going to buy a property and the bank's taking 90 days to close, you don't want to lose your potential $500,000 of upside in value. You can close with private money or bridge capital with no prepayment penalty, basically taking a 8 to 12% interest rate, which is higher, but you're able to close, pay a point or two fee, and you're not losing your deal, and you could wait for the bank to come in and fund your transaction at a 3% or 4% interest rate. So It's not ideal, but that's where I believe the window is. Anyone that could stroke a check for a couple $1 million within a 1 week period is going to have tremendous value. And again, they're going to be able to make a premium on their money for having that opportunity to help people save deals. That's where I see the biggest window. But like anything else, at the end of the day, if people got together and put the right customer-focused bank together and still played by the government's guidelines and the regulators' guidelines, but did things the right way in an expedited process, I think you're going to see a lot more longevity in the commercial banking field. What you have now is, again, like I said, the exact opposite where, hey, we're going to take a month to underwrite your deal. If your deal fits into our box and our parameters, right, based on new COVID rules and restrictions, then we'll order the appraisal. And I'm like, guys, you guys now just delayed it another 30 days, So like, I don't want to say I have like the perfect system because there'll be no perfect system. Yep. But I would basically juggle the entire process for a commercial mortgage to make it so much more efficient and most, I would say compelling for a seller to actually comply with what the guidelines are, right? I've had deals I've done over COVID, commercial deals where the bank required letters and pay stubs from the residential tenants to prove that they were paying rent and that their rent would continue.
Wow.
Yep.
But like, that's not the bank's job. The bank, it's the person that's signing for the mortgage's job. They have a 700 credit score. So you're asking the tenant who has no liability or responsibility at all.
Doesn't make any sense.
So when banks start doing that, that means that there's more problems behind the scenes that we don't see, at headline value, if you will.
Yeah.
Which leads me to believe that there are, more problems lurking.
Yeah. So we've been talking about this for quite some time.
Yes, we have.
And I'm telling anyone who will listen that if we don't shift gears quickly, this is gonna make 2008 look like a walk in the park.
Completely.
But there is a place for the non-QM loans, and there is going to be a glut of these big-time investors. I'm talking like family office money, really big money, where for generations they've had outlets, literally generations, to move their capital. Yep. And as you see markets changing as quickly as they are, particularly here in New York City, parts of California, where those outlets are not available anymore, they are going to look to deploy that capital.
They have to.
And I think that, something we weren't talking about publicly, but we'll certainly talk about it now. We're in the process of putting together a really dynamite team to get a bank started, because we see this opportunity, and we see that there's not only the opportunity in the market, but we feel like it's the right thing to do. There's going to be people who will need financing, good people on good projects that won't qualify under these new standards. Like you said, you can go through that whole process. You could have qualified right up until an arbitrary thing is changed in the underwriter's guidelines or the bank's guidelines that the underwriter carries forward. And you've invested time, you've invested money, you've made plans, you've lined up capital, and overnight you just don't qualify anymore. And that's tough. I wanted to share a story of a transaction I'm going through now. In Pennsylvania. So I'm buying a piece of property. It's a sizable piece. It's over 100 acres. And paying for the piece a 75% discount to the appraisal, right? So
to walk that through. So what I think would be cool for the consumer is you tell the story, let me play bank and tell you how the bank looks at it.
Idea.
So I'll be like, well, how about this? How about that? I'll ask the questions. You give me the facts, and I'll be like, we're screening each other.
Okay, so property's appraising for $800.
How much you buying it for?
$220.
So you're getting a discount for $580,000. Now, first question is, do you know the seller? Because how are you getting such a good deal on this?
So
make sure you're not committing fraud.
No, of course. So
that's the bank's first question.
Right? So we've got a system that works. That I've been in the business for almost 30 years, and sometimes money is not the motivator for everybody. So we have a way of identifying when properties go into a particular state, and that's an opportunity for us to raise our hand and say, hey, we can do this quickly. We can do this in a painless way. And the other side of the table has, for other reasons, they want to clear the decks. Sure. So it's a complete above board, of course, transaction.
Now, what's your goal with the property?
Land bank it for now.
Okay. Just going to sit on it.
Just going to sit on it. I am going to timber the property. Okay. So there's $500,000 in timber.
Wow.
Had companies come out and look at it legit.
So you're buying it for $220, and you say $500,000. So would you consider that as like an asset, or how would you?
Yeah, of course. So it's an asset on the site. The way it works, most of the companies will do it is 50% split. They do all the work. You do a select cut. So of course, it's not, you're not going in and raping the land. You're actually improving the forestry by trees get to a certain point, and then once they've reached that point of maturity, they start to decay and they start to decrease in value, and then they, like you're seeing in California on a much broader scale, without proper forestry management, all sorts of bad things happen. So when you properly go in and you're a good steward of the land, you'll actually foster growth. You're clearing out the canopies.
It's kind of like a
haircut. Yeah, kind of. And you're giving an opportunity for the other trees to flourish. And every 20 years or so, this is a renewable commodity where if you're responsible in how you do it, and you don't go in and totally devastate the land, every 20 years or so, you can go in and continue to harvest.
So now will this tree business, this timber business, be something that's every year? Or is it going to be something that's every so many years? Like, so you say 500,000, is that 20,000 a year for 25 years?
No, so you got to check. You got to check on the spot, right?
They cut you a check.
They cut you a check, so they'll take 50%, and then you'll pay for transport. They have to bring in these big skids, and they've got to take out the trees out, and some of them sell them locally to mills, some of them sell them overseas, but you're involved in the process. So at the end of the day, I'll end up with a check for $250,000 plus or minus.
Buying for $220 and you'll make $250,000 at least within the first 2 or 3 years.
I'll pay for inside of 12 months. I will recapture every dollar I've put into it.
So because banks are obviously looking for, and I don't want to be the bearer of bad news, banks are obviously looking for income-producing properties, right? Now, would you consider potentially doing that hard money bridge financing where you could put down, say, 10% for argument's sake, so $22,000, take out a loan for $198,000 at, let's just say, 12%, make a monthly payment of $1,980, and pay off the loan once you get that $250,000. So then that way you can pay it off at any time, just to make life smooth for yourself, rather than waiting 60 days or 90 days to deal with all these banks and then understanding what the timber business is, because they don't know what banking is and they're in banking. They're not going to understand timber.
Right.
Would that be a viable option for you to consider?
Well, are you still the banker, or are we now off? Because if you're still the banker, I'm going to tell you.
I'm a hybrid. I'll be whatever you want me to
all
be.
Right,
you know?
So let's stick with you being Mr. Bank, and I'm going to say Mr. Bank or Mrs. Bank. I've got 793 credit last time I checked. I've never missed a payment ever in my life, ever. I have liquid assets, but the bank had come back and said, you have a high debt service coverage ratio.
Is there a house on the property?
There is.
What does that rent out for monthly?
It's not rented out now. It hasn't been rented for a long period of time.
Habitable?
It needs repair.
Does it have electric and water running and everything?
It has water, doesn't have electric. I'd have to put in a generator. Okay. So they've discounted that completely. They've taken any opportunity for any income off of the table.
Are you open to putting 50% down?
If I had to, I could, but I'm not.
Because usually how we look at raw land deals, if the house is inhabitable, is 50% down. Right. Now, if you came to us with approved plans with the build, then obviously we could probably be around 70% financing, which is 30% down. So
herein lies the problem with banks.
Bingo.
Right? And now we're getting there.
Bingo.
So hold on, Mr. and Mrs. Bank.
Yep.
The appraisal says that it's worth 4 times what I'm paying for it.
Yep.
Your appraisal.
Yep.
Not mine.
Yeah, we ordered it.
Yeah.
Your appraisal that I paid
We've been using
for.
this guy since 1950. He knows how to appraise the property.
Right. And I have liquidity, and I can write a check for the property. I have 793 credit. I have multiple assets, and I've never missed a payment in my life. I got rejected, not by one bank, but by 2. Okay? So these guidelines that Jeff, Becca, and I are talking about, these are the inconsistencies that we're seeing in the banking model. Completely. And we're seeing silver linings, though, because there is an opportunity to do something pretty cool here. So
make your money back in 1 year and then some.
Literally. Literally. So a traditional bank isn't going to offer the 12% kind of out-of-the-box solution, right? And, of course, we have other options, but it's infuriating to me. That
it's insulting.
The banks are unable to look past what they should be looking, what they should be looking at, they're not.
I would say like common sense, and there's no common sense in common sense.
Yeah, I was going to say it's like robotic. They're just simply going through the motions.
Yeah, if you don't fall into that box, like if your arm's sticking outside the box, sorry.
Done.
That's it.
Move
It's
along.
over.
Can't even cut your arm off. You just can't, you're done.
So the reason that the debt service coverage ratio is high for me now is we had been involved in investment projects and COVID hit. Supply chains, lockdowns, nothing you could do about it. Now,
you and everyone else.
Yeah, exactly.
If I wasn't paying my mortgage on those properties, okay.
Different story.
No problem. Even if I requested a forbearance, no problem. I didn't do that. I paid every bill. I'm continuing to pay every bill. Some of the assets are in contract. The other ones are on the market, about to go into contract. So there's a very clear short-term answer to this, and it still doesn't change the narrative.
And they don't care.
They don't care because right now, like you very astutely pointed out, they're having liquidity issues, so they're starting to turn those levers and push those buttons and flip those switches so that access to capital becomes more and more and more and more.
Well, here's the biggest example of why I feel like people like yourself, right, and other clients that I have that, look, at the end of the day, it's the preparation to the deal. That's anything, right? So we meet up front. We go over the strategy. I give you every option, and I lay it out. I even have my clients sign affidavits like, look, banks are taking 90 days now. You're signing this document. So on day 60, when you're pissed off, I told you this,
Right.
you know.
Yeah.
But with that
That's a good idea.
because I was like, I want to close your deal faster than you do. I get paid. This is my living. You're just
Yeah.
buying that. You're getting a liability. I'm getting paid, you know. But I feel like the preparation is the biggest thing, and I feel like also people really need to understand the value in trusting. Now, banks, again, not to defend them because I don't like them just as much as anyone else does, right? I've had some of my best bankers not return my phone call in months. And about finally, I'm like, look, I sent you a lot of business. I'm loyal to you. When you had no business, you were on the street begging. I was just throwing you deals because I felt bad for you. Don't forget about me. And they're like, Jeff, you don't understand. The people that are asking for the forbearances are the biggest shareholders of our banks. So, hey, we have $10 million with you. We have $40,000 a month in mortgages. Our tenants aren't paying right now. We don't want to pay you. And they're like, wait, $40,000 a month. You have $10 million with us. Like, yeah, and they know that unfortunately they have them by the throat. Like, hey, if you don't give us this, we're pulling our $10 million. So now the people that you think would be paying their mortgages because they have it for the next 25 years over, and that's just what they have in their checking account.
Wild.
Are the ones asking, feel sorry for me. Don't make me pay the bills. So that's what they're dealing with behind the scenes, and that comes down to what's really important in moving the needle. They don't care about the guy at $200,000, $300,000. Forbearance, keep going. Because they want them to keep, paying. They don't want them to default 6 months from now. Yeah. But from the word on the street, there's a lot of people that have requested 2 and even 3 forbearances already up to this point.
Well, look, we're going to pursue this. This is going to be one of what we call the big 5, right? Yep. We sit down every year and we reevaluate our priorities. Yep. There is such a screaming need for entrepreneurs, small business owners to access capital right now, yep. responsible borrowers, that whoever solves for that wins. Completely. And wins in so many ways, not just wins financially. They win because they're going to be saving people in an opportunity at a time when they need it most. It's easy when people are rocking and rolling.
Oh,
and
of course, money flowing.
The deposits are through the roof, and everybody's lending, and we've all seen this now. I've been through 2 cycles. I'm going into my 3rd, yep. where the writing is on the wall, and you see one bank starts to lower their criteria. They start getting a little bit more aggressive, and those 80%, LTVs and
70 overnight,
and it's crazy how the banks will follow and compete. And the next thing you know, you're at 100% financing again, right? And you're at stated doc, right? Stated.
Keep the market going.
100%,
yep.
And it just is, there's no consistency to it. So we want to bring a product to the New York area to start that is going to look at what I think matters now, right? Like if I was a bank right now and I had a business that was seeking capital, the first thing I would look at, the number one thing I would look at is, were you in business during the 2008 crash?
How'd you handle it?
Did you pay your bills?
Yep.
Right?
Yep.
Were you in business, and if you were a Staten Island company, were you in business during Superstorm Sandy?
Right.
Did you pay your bills?
Sure.
If you made it through those 2,
it's a walk in the park.
This is the person or the company that I want to do business
Absolutely.
with. They don't look at any of that. They're hung up on these ratios and these things that don't matter today. And yet we repeat the cycle.
Yep.
Lenders get in trouble.
Yep.
Slap
on the wrist.
The cure is what the cure is. And, best intentions sometimes don't exactly play out the way they're intended. And I believe, look, there's a lot of great people and great banks, and I've done a lot of business with them over the years, and some of them are just salt of the earth people. But the machines are so big, and these unintended consequences start to play out, and then you end up in a position where you're going, oh boy, right? So we think there's an opportunity to do something great here. We're really excited for it. And we think that it can change the way banking is done.
I've always said that, obviously relationships are the biggest thing in any business, especially when you're dealing with money and real estate where you're living, roof over your head, right? Big investments, emotionally and financially. If you bring banking back local, they have an invested interest in lending. They know the consumer, right? And they have to have you succeed because they're a part of the community, And again, usually the Green Bay Packers as an example. If the community, for example, owns the bank and you go see your neighbor and he's making rash decisions or he's not paying back a loan, you have to look at him every day in the face, right? If you know your neighbor is with Wells Fargo, you don't care if he's paying Wells Fargo or not. But if he's paying a bank, or not paying a bank that you own shares to, you're all invested in, or whatever the case may be, as a hyper local market that we're in.
Yeah.
I think everyone wins that way. And it brings back the accountability factor. I think like anything else, preparation and accountability, I'm so big on, because when you have that accountability, right, you have to perform. You know, when you are standing in front of everybody and everyone kind of like sees you naked, right, you're kind of like, I got nothing to hide. In today's world, it's so easy to hide. And then like we spoke about earlier, you know, everyone wants a trophy.
Yeah.
So everyone was able to get a trophy over the past couple of years when, did they really work for it or not?
Look, it's tough. I think that, again, best intentions. I think that when COVID hit, we didn't quite know what this was when this thing first hit, right?
Yeah.
And you're right. We still don't. We have a better sense of what we think it is now.
Right.
It's not, thank God, it's not what some people originally had forecasted it would be. And actions were taken, and the fallout is, we're just starting to scrape the surface of what that potential fallout can be. And if we're not careful, we can end up in a really difficult place. Because
what I say is, I hope that, again, if you got the PPP money that brought you to the next level and you're still surviving because of that, but if you didn't get that, things are bad, right? Luckily, I was 24 years old running a net branch, so I know what bad months are and good months are, and I know what 2 months in any business or industry that are bad could do for you, right? It's cyclical. Whether it's COVID or just a bad run or an injury or a life-altering event, that could happen at any time. So I really hope the people that are struggling or were, again, bailed out, if you want to call it that, really take an honest look and evaluation on how they prevent this from happening again, because what if there is no bailout next time? And I want people to be able to really plan and understand, like, anything can happen. And when you take your own rights away from yourself and you can't go out, you can't open your business, even if you're digital, you can't go into your office, you can't have your employee, and those very basic rights of entrepreneurship or owning a business are taken from you, unfortunately, you're at the mercy of, a higher power. And it's not a good feeling knowing you have to pay rent when you can't even open your doors.
Well, it's the difference this time is, even if you were an entrepreneur,
right,
you still were
had to adapt.
Were put in a position where you could not operate the way you previously operated in that business. And even the most conservative business operators, people don't quite understand if you lose $20,000 in revenue in a month, right, or $20,000 in profit in a month, and the people were looking at it as, well, okay, we'll get some forbearance, we'll throw around some PPP money, we'll get through it, and then things will return to normal. People don't get that you have to make $200,000 in revenue to match that $20,000 in profit, right? If you're cutting 10% in today's world, you're doing pretty damn good.
You're probably lucky.
Right? So now you stack a couple of those months together, and now you're looking at $60,000, $80,000 in profit, right? And profit can be defined in many different ways. Right. You have your still...
How are you allocating it?
People that depend on you, right? People that have grown to depend on you, and you depend on them. Now you're talking about $600,000, $800,000 in revenue that you have to try and fill the gap at a time when banks are pulling back on access to capital. So, there's a very real situation brewing out there, and I certainly hope that people can come together and stop the background noise. There's so much craziness going on out there right now, but we have real problems that need to be addressed and real problems that need to be fixed. So on that note, we'll see where this ship sails. If you're an entrepreneur and you're struggling, it's part of the growth process. Right?
Embrace it. You're struggling for a reason, and the earlier you are real with yourself, the less long the problems will linger.
Yeah.
You have to look at give yourself a real approach to
that's hard to do.
Look, it comes down to pride. It comes down to not wanting anybody to know what's going on. It also comes down to, basically you understanding what's going on. Most entrepreneurs don't understand finances, right? They don't understand business. They just know.
It's shocking to me.
They never taught it, right? So it's like, hey, I'm a great painter. Okay, I'm going to paint this wall for $500, right? And then you never had to buy the paint before. You never had to commute there. You never had to buy business insurance. You never had to put gas in your truck because you were given that. Now you're like, wait, my car payment, actually, I have to charge $700 to make money.
Right. Yeah.
But they look at it as...
They just don't think about it.
They just don't add it up. They're great at what they're doing. They're great at their craft, but they don't have the business mindset. So the earlier you understand the pluses and minuses, the much better off you'll be.
Without a doubt. Yeah. So I wanted to talk a little bit about, still in the vein of financing, market disruptors. Obviously, we've covered COVID, I think, pretty thoroughly. Let's talk technology. Let's talk about, some fintech and how it's disrupted the residential side to some extent.
Sure.
We haven't seen much of that on the commercial side. Why do you think that is?
Old school people, they call it long money. Money's been there forever. Very few new players are getting in. Guys, like my best friend, my son is my best friend is my son's godfather, and vice versa, and he's 35 years old. He owns a piece of 17 commercial properties. Started buying, a decade ago. He owns pieces of a bunch, and there's just big groups, right? So it's kind of like commercial real estate. You have one guy that started out. He brings in his kids. The kids bring in their friends. They bring in their partner. Then you have a group over here that owns retail centers. Now they start bringing guys in because now they want a piece of their action. So it's kind of just like a big growing circle. Also, like anything else, it's very hard, to really value a property, right? So I think people have to still have more of that personal approach. Like, hey, does a Starbucks fit here? Because if we could put a Starbucks here, this is going to triple the property, right? It's a much more professional side of the game than residential real estate, less emotional, I would say.
Yeah.
But it also takes that in-person experience to understand the true value of commercial real estate. What can we do with it? Can we knock this down? Can we put apartments, buildings on here? Can we add another level? What's the price per square foot? What's the triple net? There's so many different factors that you can't understand it from doing it in a book. You have to do it, right? So you have that constant growth and evolution. And like anything else, when something's hard, your average person's not going to go through that longevity of it, So I think that deters people away. Also, I think that residential just took so much of a focus from 2008. People still don't understand residential mortgages. And I have some of my smartest clients that are commercial guys that don't know anything about residential mortgages at all. Like my best friend, he doesn't understand because it's not his world. It's not his wheelhouse. And it's still real estate and it's still money. So as far as adapting, if you can get the consumer to adapt, you have to bring them value that they've never seen before. Getting somebody to adapt in general to anything, especially technology at an older demographic, it's just not happening anytime soon, So I don't think commercial real estate adapts truly to technology for another 10 or 15 years. I hope I'm building out a platform that people will be able to utilize in the commercial space. But again, I'm building it out for residential because even though residential deals are smaller, there's 100 times more transactions, right? Much easier to get done. I just think that as time goes on, most people would rather close 10 residential deals than one commercial deal. But on that one commercial deal, you might make 100 times what you make on those 10 residential deals.
Sure.
So adaptation and then user engagement.
So we think that there's a place for all of the above. We think that the world is ready, particularly the Northeast market is ready for a return to the grassroots banking institution. They're ready for more technology in the space. We actually have a program on the real estate side that we do also on the commercial lending side called the RPO. It's the Real Estate Portfolio Optimization, where exactly what you just said. If you don't know it intimately, you can have 9 out of 10 of the best professionals in the commercial field look at a property and come up with a very similar analysis.
Right.
But if you pay a professional to really peel back the layers, there is value everywhere.
Everywhere.
Right? If you slow it down and
how many more parking spots can we add at $350 a month?
I
think that's what it breaks down to.
There's so many nuances that the traditional formulas don't look at. We only take like 4 clients at a time at that level because it's such a deep dive.
It's grueling.
But when you start looking at buildings that are income producing right now that are tenanted and we're slating them for demo, right? Like that's aggressive, but there's a place for it.
Long-term value.
Oh, man.
There's so many things, though, that if you're not an expert, you just wouldn't even think of.
Yep.
I mean, it's beyond common sense. It's just things that you might only know from experience. So
25 years of doing
Exactly.
But again, think about it. Like you say, hey, I bought a house. Think about how much anxiety goes into that. Now you're talking about a commercial building with variances and architects and triple net leases and water, sewer, and all these crazy things, right? Like I actually had a client. It's funny, a commercial client that bought a piece of land here. This is Victory Boulevard right here.
Victory is over here.
Okay.
Yeah.
So bought a piece of land on Victory Boulevard, and they didn't realize that it was too close to the road. So I'm giving an example. They thought they were going to be able to build, like, say, a 10,000 square foot building, but they didn't realize because of the side of the road it was on, there was like a different exception where like they could only build like a 4,000 square foot building. So like their values that they were projecting, like, not for nothing, they're going to lose $500,000 because, you know, hey, I got this great deal. Oh, look, this is what Tony bought it for. And the next thing you know, it's like,
tough.
Yeah, you way overpaid for the land, and by the time you build, you're all in, like, you're short, you know? So, like, little things like that, like, I'd rather have a broker that knows what the heck they're doing, that's in the game, that's invested in the game, that says, hey, don't do this, even though it's not really your model, rather than put in, like, office and residential, maybe we just go parking lot, or whatever the case is. You might make a little bit less, but you have less risk.
Jeff, you get what you pay for.
Hands down.
That's
in every aspect of life.
That's just it. It never ceases to amaze me how many people still rely, even for commercial transactions, on people that they know, that they're comfortable with, that are, you know, a friend of the family or in the family, instead of hiring a professional that eats it, breathes it,
What do you think?
sleeps it.
Is that a fear factor? What do you think?
I think there's a couple of things. I think that it is a lack of understanding how deep the process goes. So they can't fathom the layers and the things that where there's exposure everywhere,
like the behind the scenes,
that they don't have any sense of. I think that there is a sense of ego. I think that people, you know, I know some really successful people that never went to the next level because they didn't get comfortable with surrounding themselves with the smartest people they could in the respective disciplines. So I think that there's an ego factor. I think there's a comfort factor, a familiar factor of wanting to, you know, well, I know this person. How much of a difference could it be? Brother, the difference is profound.
You just gave me the funniest story. So I have a client that I'm in the process of working on getting a deal closed for, and he always would say to me, I'd be like, hey, do you know what this means? I'm an engineer. I kept saying, I'm an engineer. I'm like, okay, but you're my borrower. I don't care if you're a dentist, a doctor, a pilot. I don't care, you know. You could do whatever you want. You be a comedian.
Exactly.
You keep saying you're an engineer, right? So, like, 2 months goes by, and now we get the final 1003. Now, the 1003 loan application, as you know, it's the same one from 1980. Like, they haven't changed this, like, 4-page, 5-page application. It says in 40 years. So, this is the best ever. And, like, I like to push my buttons a little bit for my clients. So, I'm like, okay. He's like, oh, Jeff, I have some questions on the 1003. I go, wait, but you're an engineer. You know, like, you knew all these things that I knew you didn't know, but like, you don't know where your assets go on the 1003. You know what I mean? So like, I think you're right with that, where people don't want to come off as like they don't know something. I'm the type of person like, hey, you're a professional. I'm going to trust everything that you're telling me. You know, do your job. You know, and I think more people have to rely on that, but because of the anxiety and because of what's gone on and the bad headlines in 2008, it's made us be underappreciated. But it's also unfortunate that every day that goes by, more inexperienced people are coming into the business, creating more noise. And there's guys like us out here and girls like yourself where, hey, we're sitting at the top, but we're not loud. So now we're not getting the right attention, and we're cutting right through all the bullshit, right, to get you the right answer. And the real people don't appreciate that because they're being told no. They're being like, oh, I'm not good enough? Okay, go back to this guy, you know?
Well, if it's too good to be true, it probably is, right? So, look, I'm going to have to ask that you come back on the show because we didn't even touch on so many other things I wanted to touch on. But, like, we're rolling over an hour already. Is there anything else you wanted to catch before we wrap this round?
I would say anything, you know, like right now, the best thing you can do is plan and don't make emotional decisions. I know a lot of people, a lot of friends, a lot of clients, very, very smart, successful people that are being impatient with having money in the bank. And I could tell you, I've had a lot of money in the bank, and I've had no money in the bank, right? If you feel the need to spend your money in the bank, don't. Like,
keep your powder dry.
If you wait, I tell everyone, I wrote an article, like, we're not going to see the worst of this until at least March of 2022. And that's based on, you know, obviously all the stuff prior to me writing the article. So I wrote the article when it came out in like April or May, with the forbearances and the rent, you know, halts and all that stuff. We might not see it for years after that, depending on what legislation does and what the courts do. But it never hurts to have money in the bank. I don't care if you're making 0.16% on your money. Making 0.16 is better than, you know, taking your life savings, putting it on the line, and losing a piece of it. You know, people don't realize that. And the other thing is, people that are buying properties right now, keep as much money in the bank as possible. Finance as much as possible. with interest rates being, under 4% on both commercial and residential mortgages,
money.
borrow as much as you can. You could always pay the loan off.
Yeah.
Once you put the money into the property, there's a very good chance you will never be able to access that money if you need it. Yeah. So that's the two biggest mistakes I've seen people make in the past, 6 months. Putting too much money down and then just not making the right decisions.
Yep.
Thinking that, the knife has hit the ground, and I believe the knife is still falling.
Yeah. Look, I think that we're at a pivotal point. I think that some of our leaders are right there, and if they can, move us over the hump, I believe that there is a lot of opportunity in front of us. I think that there's a lot of silver linings. There always is, there always has been, and there always will be.
Yeah.
But the next several months are going to be really pivotal. So, on that note, this was a wonderful chat. And I really appreciate you coming.
Thanks for having me. Appreciate you guys.
We'll
get part 2 back on the books.
No doubt. I mean, I want to dive into the tech stuff and some of the other things.
That's exciting stuff. This stuff is just kind of like boring, setting the tone, letting people know our insight, what's in our mind. But the tech stuff is really where we can show people, I believe, our vision and hoping to get people to buy into what we see based on experience.
All right, man. We'll do this again.
Thanks for having me.
Absolute pleasure. Listen, everyone out there, very much appreciate, as we always say, please keep the comments coming, the suggestions coming. We're having a lot of fun with this. We hope we're delivering some value. Everybody out there, please stay safe.